Bismillah ar-Rahman ar-Rahim. Welcome to SIB Najah Islamic Finance Education Series. In today's series, we want to look at how Islamic financial institutions avoid riba. Riba is interest on loans, is the benefit that the creditor gets out of lending transaction, and we had elaborated this in detail in the previous session. Probably many wonders how then an Islamic financial institutions regulated by the central banks can be able to do business without charging or paying interest. And this is how they can do it. Islamic banks, Islamic financial institutions, they use a diverse range of contracts which are allowed in Shariah, of which it allows them to generate profit or rental income or fees out of their activities. For example, they can use a profit-sharing contracts like the Musharaka contract, which is a profit and loss sharing contract whereby both parties contribute capital and share the profits out of the business venture. Or it can be a mudaraba, or they can use trade-based contract, which are sell-based, whereby the bank or a financial institution sells something that the client wants for a profit and give him time to pay slowly. Or it can use commodity murabaha, which again involves an asset which the bank will be selling at a profit to a client. Or it could be using salam and istisna contracts, which again entitle the bank to be able to make profit out of a sell transaction. Or it can use ijara contract, which is leasing. Islamic financial institution can buy a house and lease it to its client, or they can partner to own that assets of which it will be leased to the client and then of course ultimately sold to the same client. These are operating and financial lease, which can all be used in Islamic financial institution that entitle the bank to get rental revenue or rental income. Finally, it can also use wakalatul istithmar or investment agency, which is a contract whereby the client could be giving money to the bank as an agent of the client to invest it, and the profit that are generated will be paid to the client while the bank taking it as fees. So Islamic financial institutions don't need at all to use a loan contract, which is giving people money and just charge them interest on a defined payment period. So profits, rental income, and fees through the correct application of Sharia compliant underlying contracts are the ways that Islamic banking and Islamic financial institutions use to avoid interest.